Good afternoon, everyone. Good afternoon. I don't know if you can hear me. Good afternoon, everyone. Thank you for joining us on today's webinar section. Topic, Forex Fluctuation Changes and Opportunities. My name is Alabolu Afunke, the Head of Career Service, and I'll be introducing you to the moderator today, Mr. Babatunde Fajobi. He will be introducing us to the speaker for today. Babatunde Fajobi, are you there?
Yes, thank you, Funke. I'm here. Yeah, thank you. All right. Good afternoon, Joby. Thank you. Okay, Funke, should I?
Yes, thank you. You can proceed, yeah.
Oh, do I have the floor now? All right, thank you. Yeah. That's it. And the management of Rome Business School for the opportunity to moderate this session. Today's session is very, very important. It's critical. And I can assure you that it's going to be sorry, hello. Yes, I'm back. Our topic for today is FX fluctuation, opportunity, and challenges. And our speaker for today is someone that is well versed in terms of experience, in terms of exposure in this line. And as it's creating problems, it's creating challenges, it's creating opportunities. So today we're going to be afforded the opportunity of learning the challenges around it and seeing the opportunity in it, so that we may be able to create some values to help us as individuals and even probably the organizations that we represent. Mr. Tony Nwosu is our speaker for today. His experience has been a banker for many years, rising through the rank to senior management level. He has been exposed and he has trained as an FX dealer and at the same time as a trade finance expert in the bank. So today we are in good hands. I believe that we are with someone that is quite experienced and knows his onions in terms of the topic that is going to be speaking to today. I want to encourage us to executive students to prepare.
Hello. I think Mr. Babatunde Fajobi is having a network issue from his end. Please bear with us. I think. Hello, Mr. Babatunde Fajobi. He's having a network problem. Hello, Mr. Musu, are you there? Mr. Musu.
Hello, can you hear me? Can you hear me?
Yes,
Hello?
we can hear you, sir.
Okay.
We can hear you, sir, Mr.
Okay, so can you also see me?
Okay.
You can see me
Yes,
now?
we can see you
Yes,
now.
we can see you. We can see you.
Okay.
Okay. Okay, I think Babatunde Fajobi is back. I am clearly seen.
Yes, sir.
So do we wait for Babatunde to conclude before I start talking?
No, I think we can proceed. We can proceed. I think he's having a
can
network challenge
proceed.
from his end.
Okay, I believe everyone should have the screen. Let me just minimize this so that I can see my slides. Just a minute, please. Okay, so good afternoon, everybody, once again. Babatunde has spoken a lot about me, so I will talk less about myself and talk more about the topic for today, which is Forex fluctuations, the challenges, and the opportunities. Now, we're going to take ourselves through a short ride. It's going to be 60 minutes. We're going to try to manage our time because it's a very vast topic. So we'll try to streamline and summarize in order for everyone to understand what I'm saying and be able to ask the questions as they come. Okay, so is everybody seeing my slides? I want to be sure everyone is seeing the slides.
Not yet, sir.
Okay, Funke, do you want me to do share slides?
Yes.
Okay, let me just hold on a minute. Let me see, share screen, okay. So these are the slides. Can you see the slides?
Not yet, sir.
So I've done my share screen. Share. Can we all see the slides now?
Yes, we can see a slide.
Okay, so we can all go ahead. All right, so I usually like to start my discussions with sayings that kind of help everyone tune into the mood of the conversation or the lecture or the webinar as may seem. I'm a fan of Franklin Covey, the company and the author of The 7 Habits of Highly Effective People. And for this particular webinar, I have chosen to pick one of the 7 habits, which is seek first to understand and then to be understood. What this means is simple. We are going to talk about a market that is vast, an international market, not a Nigerian market. And it is, as the time goes, as the lecture goes on, as the webinar goes on, you realize that you need a whole lot of understanding for you to be able to play in this market. That is why I brought out this for everyone to see. So first you seek to understand, and then you can now start to make other people understand you. So basically what it says is you listen first, understand, and then you now start to talk for others to understand you. So I have done my part by learning over the years and getting my experience. And now I think I can seek for others to understand me. We go straight immediately to what Forex is. So I'm going to start as primarily as possible, so that everyone understands me. Now, what is Forex? It's an abbreviation simply of foreign exchange. Everybody uses the word, but I can bet you that 50% of those that use the word don't even know the full meaning of Forex. Now, foreign exchange quotes is a statement of willingness. If you want to buy or you want to sell, they're going to place a quote. Now, there are two ways they do that. You either put it in the symbol when you see dollar naira or dollar pound or euro dollar, or you use the alphabets USD, EUR, as is seen on the slides there. And this is the International Standard Organization 4712 code. It is used based on the alphabets used to abbreviate the currency. Now, when we talk about a quotation, on our slide there, you can see there is a base currency and there is a price currency. So the quotation indicates the number of units of the price currency required to exchange to receive the base currency. So if you are doing euro dollar and you say 1 euro is equal to $1.2, it means that for you to buy 1 euro, you need to spend $1.2. If you are going to do USD Naira, you will see one USD can be purchased with 515, so to speak, Naira. So just to make us understand the rudiments of FX trading and the FX markets. So the quotation is the quote you place, showing the two currencies, one being what you need to spend to buy 1 unit of the other. Now, I want to believe that this is very clear and a bit common to most of us. So on my screen there, it shows a direct quote is a price of a foreign currency in the domestic currencies unit. So $1 is equal to 411 Naira, basically, in the I&E market today in Nigeria. An indirect quote is the opposite, where you say 411 Naira is equal to $1. Most times in the markets and in practice, we use the direct quote, which says $1 is equal to 411 or 412 Naira. Now, I'm not going to confuse anybody with the rates. As we go along, you will understand why there are certain rates and why the rates are being used. We'll use Nigeria as an example to make things easier and for clearer understanding. So as I said, in practice, that's what they call the bid and the offer. The bid is your buying price. The ask or the offer is the selling price. So when I say 1 USD to 411 Naira, I'm saying that I want to buy that $1 for the 411 Naira. So the 411 Naira is what you are being offered to sell that price of $1. So the bid is the buy, the offer is the sell. Always remember that: bid and offer, buy and sell, bid and offer, buy and sell. Now, let's go on. Now, the foreign exchange market is the largest market where every participant buys, sells, exchanges, speculates, news flies around, and all of that. It is known to be a market that is the most liquid in the entire world, running into trillions of dollars. Okay, and that is what makes it a very special market. And when you say something is the largest market in the world, obviously it has a lot of interest from world powers. It's extremely large, it's extremely liquid. And in the next slide, you see the characteristics of the FX market, Forex markets. It has huge trading volumes. It has extreme liquidity. There's a geographical dispersion, which means that you can trade in anywhere in the world, in Nigeria, in America, in the UK, in Australia, in Asia, anywhere at all, at any point in time. The next point there is continuous operation of 24 hours a day. Now, the 4 trading time zones are the New York zone, the Tokyo zone, which represents Asia, then the UK zone, and some other people put like Hong Kong or so. So you'll find out that when US is waking up, Nigeria and the UK have already gone far in business. When Nigeria and UK are going far in business, they're already sleeping in Asia. And then in Sydney, it's a different time. So as one geographical location is sleeping, the other geographical location is waking up. So the FS market never really sleeps. It's a 24-hour market. I have traded at 2 a.m. Nigeria time before. I've traded about 4 a.m. Nigeria time before. Because at 2 a.m., the markets in Hong Kong, in Japan, in China are all getting up to start trading. So you find out that you can trade at any time of the day. it's not a one size fits all in terms of the timing and geographical location. Now, let us look at other characteristics. It has variety of factors that affect the exchange rates. It has use of leverage. As we go, you understand what that means. And then there are low margins, but as you trade, there's large turnover. So imagine you are buying $1 million and you're making 50 kobo. To a mere person, you say you're only making 50 kobo. But 50 kobo on $1 million is 500,000 naira. 50 kobo on $2 million is 1 million naira. They are small margins, but the volumes you trade give you a lot of profitability, which makes this market extremely liquid. Now, there are factors. These are the factors that influence the exchange rate. So when you hear an exchange rate has gone up today and has come down tomorrow, what is making it go up? What is making it come down? There is something. It's not just the traders. The traders are trading based on differentials in inflation. The traders are trading based on differentials in interest rates, current account deficits of a country, the public debt, the terms of trade. Now, I'll give an example. In the last 3 years, Nigeria has seen our rates go from about 380 to over 400. We know that there's high inflation in Nigeria. It has crossed 15%, it has moved to 17.5% and almost hitting 18%, if not more, as we speak. Now, if you look at our current account deficits, we do have deficits. You always hear about Nigeria borrowing money. If you look at the public debt, the point there, we are borrowing money from the IMF, we are borrowing money from the Paris Club because there's a deficit. The country wants to borrow money to be able to run its business in the country. And when you are borrowing money, it affects the strength of your currency. And when it affects the strength of your currency, the international market is watching, and that strength is traded, which is why you will see volatility or fluctuations in the Naira dollar. This is not peculiar to Nigeria. In the Eurozone, there are also peculiarities. In the UK zone, there are also peculiarities. When Brexit started, there were fluctuations in the pound rates. So those trading pound USD, GBP USD, and
sorry, Mr. Anthony, could you please put it on the flash, a share screen?
Hold on.
Or a full screen.
For the slides. Slides, yes.
Yes.
Let me just look at this. Just a minute, please. Full screen, just a minute. I get this done. I don't seem to be getting it right, so just give me a minute on this. Okay, share screen, pause. I can see this now. Share. Let's see. Has it changed?
Yeah, it hasn't.
It hasn't. Let me just go back again.
So
I don't seem to be getting it right. Let me just try this one more time.
Okay.
Share, stop share. I'm going to do it all over again. Share screen.
Hello, sir.
Okay, yes.
Okay, just watch me the way I do mine now. You share.
I
Okay,
can't
just
see. So I go to you share.
No, pay attention to my screen now. I'm trying to guide you on how to do it. then you come to this axis.
I
This
can't
is where,
see you.
so can you see my screen now?
No, I can't see you.
Sharing my screen. Can you see my screen?
I can't see you.
You can't see my screen.
No.
I've shared my screen now, sir. I'm hovering my mouse on an icon. That is the share full screen icon. Can you see it?
No, I can't. Just hold on, please. I need to go off anchor. Okay, yeah, the one. Okay, I can see you now. Yes.
Okay. Can you see that I'm hovering my mouse on an icon? Can you see my
this on the right hand side? Select, find,
yeah.
replace.
No. Down the screen, just a little above the tax bar. Are you right? Are you seeing my mouse now as in a pointer? I'm hovering it.
I can't see you.
I need to stop.
Okay, I can see the screen. I'm seeing you now.
Okay, just check your right side where you have to zoom the slide.
Okay.
Beside it, you'll see the shared screen.
Hold on a minute. So I'm on shared screen now. So I click on my shared screen. The slides are. So how do I now adjust the slides? Let me just be sure.
We can't see the slide yet. Okay, Philip will share from his side.
Philip, please share from your side so that every listener can see this, so that we don't waste too much time on it, please.
I can see. Can you see the slide?
I can see the slides, but
okay.
I can't move it. I'm having issues with my own. Just a minute.
Oh, Philip will control it from his hand. You just need to let him know when to move the slide.
Okay, I'm trying to minimize my slides. My slides are too light. I'm trying to minimize them. I think I'm having some issues. Please just hold on a minute. Philip, please, I want to be sure that you're seeing me first of all. I'm starting all over again, so I make sure everyone is seeing me.
Yes, we can see you.
Can you see me?
Yeah, we can see you. Philip is sharing the slide. You just need to follow through with what he is sharing. So you just need to stop sharing from your side. Okay,
I'm not sharing from my side, and I'm only seeing. I can't see my main slides. What slides are you on now, Philip? Slide 1, 2, 3, 4, 5, 6, 7.
Unfortunately, it's not numbered.
I'm on slide 9.
Now I have seen it. You moved out again. You moved out again.
Can you see the slide?
I can see, but it's too massive. It's too big, so I can't see it. It's actually like projected like a maximum. So maybe it's from my end. Let me just watch my end again. Okay, you're on slide 10 now, but it's not. It's too large. I'm trying to minimize it. I'm trying to minimize. Just a minute, please.
Okay, you can share from your hand if you're having challenge with this.
I'm having
the size of the
Let me just hold on. Can you all see the slides now?
No, we can't.
You cannot. I am seeing the slides now. Okay, let me now share. Now my own side is better, so let me see if I can share it properly. Share slides. Can you see the slides now?
Yes, we can see the slides, sir. So you can continue.
Okay. Can you also see me on video?
Yes, sir, we can see you.
All right. So I think I was talking about the characteristics of the forex market. So let me just roll back a little bit. So we talked about the foreign exchange markets having participants that do buying, selling, and exchange and speculations. We also talked about the foreign exchange market being the largest and most liquid market in the world. We also talked about its geographical dispersion, where I mentioned that the UK zone, the US zone, the Sydney zone, and the Asian zone all trade like a cycle. When US is waking up, Nigeria has moved on, and UK has moved on. And also when Hong Kong is sleeping, Nigeria, UK, and US are all waking up, to show you that it's a 24-hour market. Now we'll just go straight to how it affects the economy. Now, how do fluctuations affect the economy? How does the forex fluctuations affect the economy? Let's start on the microeconomy, which is you and I. The exchange rates affects prices of goods that are imported. The value will go up or go down based on the interest rates. Because we know that as a country, using Nigeria as an example, we are an import-dependent economy. So assuming that you bought a car for a certain amount when the dollar was at 380, if the dollar goes up to 450 the next day, there will definitely be a change in the price of that car. So if you look at the slide, it says that when exchange rate changes, the price of imported goods will change in value, including the domestic goods that we all buy because they are import-dependent. Now, further to this, your savings, your disposable income, standard of living are all affected by these fluctuations. As we go, you will get better explanation on this, and that will now dovetail into the macroeconomy, how it affects the macroeconomy, and also dovetail into the trade, because it is trade that rules an economy: imports, exports, international trade. Now we are talking about the macroeconomy. Here, it's stated that the exchange rate fluctuations impact investment performance, interest rates, and inflation. Now, imagine that a company from Asia wants to invest in Nigeria. If they bring $1 million into Nigeria at the rate of 380, they have invested 380 million naira. So they are going to get a certain return based on 380 million naira. So let's assume they're doing a fixed deposit at 10%. They've brought in $1 million, exchanging at 380 million naira. And at 10%, they're going to get 38 million at the end of 1 year. The same company will bring in 1 million when the exchange rate is 450 million naira. So the same 1 million that came at 380 million naira, which was an investment at 380, the same 1 million has come in and is now 450. You can see the impact on interest rates and the entire economy. It even extends to jobs. If a company was doing certain things, making a certain level of profit based on exchange rates in the country, for instance, a manufacturing company, when the exchange rate becomes a bit adverse, you find out that prices will change. And when prices change, their revenues change. When the revenue of that company changes, their profitability also changes. And you will not see a company that is going lower and lower in profitability, employing more and more staff. So it's a direct or indirect relationship to employment or unemployment in the markets. Now, what is the impact, or what are the impacts of Forex fluctuations on international trade? It tends to devalue, it tends to reduce the value of a currency or increase the value of a currency. So let's take Nigeria again as an example. We import used cars, we import machinery, we import toys, we import raw materials to run our chemicals in our industries. When the rate goes up, the importation costs increases. So cost of production increases. And when cost of production increases, obviously, the price is going to be passed to the end user. So we used to buy soap, a bar soap, bathing soap, toilet soap. We used to buy other imported products at a certain amount, at a certain price about 2 years ago. But because our exchange rate has gone from 380 to 410 to 411 to 450, even in the black market over 500, we see that we are buying the same products at an increased price. Why? The fluctuation in exchange rates, which made it go higher, has caused an increase in importation costs, an increase in the cost of production, and an increase in the purchase price. Now, let us also look at reduction in profitability for businesses, which is dependent on the imports. So you find that a company does production of maybe 100,000 units of a product in one day. And then because of the exchange rates, maybe the fluctuations were not to the advantage of this company, you find out that they are producing probably less or producing the same amount, but with higher price. And with the higher price, you find out that people's disposable income or purchasing power is not as much as it used to be. So because of that, people are going to buy less. And when people buy less, they make less profits. The negative changes also happens in the banking industry. Some years back, when the serious dollar scarcity started, you find that there were policies in opening of LCs because each bank in Nigeria has a corresponding bank abroad that opens their letters of credit for their customers. Because of inflation and the rating of Nigeria based on economic changes and especially our currency rates, you find that these correspondent banks started giving banks certain conditions to open these LCs. The pricing changed. So what we usually price a bank at 1.2% for issuing LCs or 1.5% went up to 2.5, 2.75 or 3%. Where does this cost go to? It goes to the importer. And where does that cost go to from the importer? It goes to the end user. So these are things that affect the international trade. So it either increases the trade or reduces the trade based on the fluctuations in the markets. So to look at a summary of the opportunities and the challenges, you can see that people who have their personal funds, their savings will reduce. It's difficult to plan when there are fluctuations. Your standard of living is affected, your disposable income also, and of course your investments. Now, I always tell people who talk to me about managing their funds, and I say that when you have your money with you, your funds, there are 3 levels. 1, your salary comes to you or your receivables come to you, and then that is your disposable income. Now, from your disposable income, the second thing is that you have to save money for your disposable income. Now, the third thing, when you save money for your disposable income, you can now invest from the savings. So if I get 1 million naira a month and I save 500,000 every month, after 10 months, I've saved 5 million naira. From my savings, I dip my hand into my savings, and then I start to invest in bonds, in treasury bills, in fixed deposits. Now, if my disposable income is reduced because of the economic effect of these fluctuations which affected our currency, you will find out that the disposable income has reduced. Therefore, savings will reduce and investment will be negatively affected. Now, take a look at this graph. It's an overview of the fuel pump price between 2000 and 2020. You can see that at a point we had 22 naira. At a point it hit over 100 naira, over 150 naira. Now, with this kind of fluctuations, you can see that in some parts of the graph, there's an extension which shows when the prices went high and sometimes when the prices went low. Now, when prices of petrol pump price fluctuates, it affects everything in the market. Remember, your farm produce, your food baskets, orange, tomato, bread, these things are coming from somewhere. In agriculture, they call it farm gate prices. So the farm gate price of a dozen oranges is probably 100 naira, but you're going to put in costs. So for the cost accountants, they will tell you they're going to put in the cost of buying petrol and transporting it, the cost of maintaining the car, the cost of maybe security or something. That's 100 naira. By the time it gets to the market for people to buy it, like you and I, the households, that 100 naira is translated to 170 naira. So because of the fuel pump price, there's an element of cost that has increased in the cost of the dozen oranges. The next slide goes on to show you inflation, unemployment, investment, which I had mentioned earlier, and business profitability. All these are affected by the Forex fluctuations. And like I said, it affects the households who make up the microeconomy, and then it affects the macroeconomy. And of course, when you say it affects international trade, it means it affects the macroeconomy. Because international trade, you're talking about the countries now, not the households. And once it affects the countries, it affects the households. Now let's just look at it practically. We'll pause a little bit. How much was a fairly used Toyota Corolla, which is usually used for your Uber or your Bolt, 3-4 years back? The car was below 1.7 million, below 2 million. Today, the same car is over 2.5 million. Why? Because the exchange rate has increased. Like I earlier said, $1 million at 380 is 380 million naira. $1 million at 450 is 450 million naira. The same $1 million at today's black market price of over 515 is over 500 million naira, but it's the same single $1 million. These things affect business profitability and the macroeconomy. So if you look at the graph on this slide, it shows you the rate from 2000 to 2016. We moved in 2000 from less than 130 to over 300 in 2016. The graph between the 200 mark in 2015, that's 2015, and the mark over 300 in 2016 leaves a lot for you to think about. So I pause a little bit and we ask ourselves the question, are there only challenges in this market from what we are seeing on the slides? The answer is no. Remember, in every challenge, there are opportunities. In the days of fuel scarcity, people took opportunities. The days that there are fluctuations in trading, people will take opportunities. The COVID lockdown of 2020, if you listen to reports of the FMCGs, the fast-moving consumer goods, they all made profits. If you look at the financial reports of the IT companies and the IT-related companies, they all made profits. Why? People sat at home and were eating food. People sat at home and were working on the internet. Those were the opportunities for them, while others were facing challenges. The medical people were selling face masks. They were selling medical apparatus and were making money. So wherever there are challenges, there will be opportunities. As we go on with the slides, you will tend to see the opportunities, both for businesses and for the traders. Now, these are the opportunities in terms of Forex and fluctuations. There are a lot of people now that are entering into Forex trading platforms. During the lockdown in Nigeria, which was between February, March, and about September, October, of course, various countries had their own lockdown periods. People tried to look at what they could do from their houses. People were introduced to Forex trading, and someone says, hey, you can sit in your house, give us an equity of $200 or $100 and start trading on a platform. So that became an opportunity for them. Based on that opportunity, people started trading and making profits from volatility of the trades, which we are going to see in other slides. And then that now became the advent of payment services companies that realized that companies in Nigeria were looking for Forex, could not get it because there wasn't enough supply from the central bank. And therefore, they had to look for other windows to buy the Forex from. So what did they do? They went to payment service companies that offered financial services and say, hey, I need to buy $100,000 because I need to buy chemicals for my production. How much are you selling? So you find out they're not getting the central bank rates, but they don't mind the fluctuations. This is the buyers now. They're willing to buy it at the expensive black market rates and make their payments offshore. So these are opportunities for those companies, opportunities for people who were the households, who stayed in their houses about trading FX. Now, as we go on the slides, we now come to the Forex trading proper. For those, I know that a number of people are hoping to look into this webinar to see what they could make in terms of ideas and opportunities to do their trades. Now, the slide looking at all of us shows the popular trading platforms in the world. These are not the only trading platforms, but for those who do online trading, I'm sure Oanda and FXCM are quite popular. FX Pro is also popular to them. eToro is also popular to a number of people. These are Forex trading platforms that people have found during the lockdown as opportunities. Subscribed to them and started trading. Okay. Now, I want everybody viewing these slides to keep this as a tip for every successful trader. A number of people want to trade. A number of people do not know what it takes to trade. If you are in the finance field, you will know that trading has a very high level of risk. I have put it out here that a successful Forex trader is one who has great judgment and applies it to every one of his trades. Every one of his trades. The judgment is important in Forex trading because of high volatility. Now, you can trade normally and make normal profits. But traders look out for volatility and fluctuations. That is when you make abnormal profits. So people sit back, listen for economic news. And from economic news, they get to see, they get to hear what is about to happen. Today, if the European Central Bank, the ECB, is about to issue a statement that will affect the euro, you find traders who are positioning the euro because they know that the effect may either be an upward trend, so the currency is going to go upwards, north, or a downward trend. As we go on in the slide, you will see how people do position trading, how traders position their buy and their sell to be able to do their take profit and do their stop loss limits. Volatility is a measure, which is what many people ask. What is volatility? The fluctuations up and down bring about volatility in the market. It's a measure of the price change, simple, during a specified amount, a specified time. Once there's an announcement, there's volatility. People are trying to react to it. People are buying, people are selling for their own different reasons. When markets are volatile, it means that the prices are changing very fast within a short period. So if you look at the diagram below, you would see volatility of a market where a currency is going down. People are selling down. But in that downward trend, you can see that some points, the market goes up and then it goes down, and it goes up again, and then it goes down. This could be a period of 5 to 10 minutes. It could be 30 minutes to 1 hour. It can be 2 hours to 3 hours, but definitely not over 6 months. So it's a short period when the volatility happens. People now take position to either buy or sell. For instance, if you bought a currency, let's use the Naira as an example. Even though the Naira is not popularly traded like the Euro USD or traded like the GBP USD or GBP Euro, if you bought money at 400, and today they tell you that they're going to bring out a news that is to the advantage of the Naira, it means that the Naira is going to gain against the dollar. So if you bought at 411, you have to ask yourself, if this news comes out, what would happen? What will happen is that if the Naira is going to gain, it's going to go down to 410, to 405, all the way down into 390. So those that are intelligent traders who have bought at that rate are not going to sell at a lower rate. They are going to wait for it to go all the way down, and then they will buy. Or they do what they call short selling. You sell when it's high and buy back when it's low, which is an opposite of buying when it's low and selling when it's high. As we go on, you will understand this. I'll take a minute and I pause. What is volatility trading? It is trading during that volatile period. All currency pairs experience a change in price during volatility. And volatility trading refers to that trading that you do during that particular period when the volatility is going on. Now, there are two major types of volatility. There's the historical one, which is the normal price action over a couple of months or even a year. They are very slow. But there is the main volatility where traders love to trade in, which is implied volatility. It is implied because it's caused by a certain news. Typical example, when central bank announced that they are going to suspend issuing licenses to BDCs, the Naira dollar rate moved from rates of about 490 something, 501, and it hit 525 at a point. That was volatility for one and a half weeks before it started coming down. That is your exact example of implied volatility. It's volatility that was implied by the news that the Central Bank of Nigeria brought out about BDCs, and different people holding different positions, be it a buy position or a sell position, took action to either curb their losses or to increase their profitability. So traders who trade on volatility don't really worry about the direction, be it up or down. They're not bothered about it. They're not trading that currency. What they are trading is the price of the currency pair. So when the Federal Reserve Bank in America brings out news that makes the dollar stronger, immediately volatility traders will buy dollar. Let's say between dollar and the euro, 1.12, and they sell it when it's at a better price, and you've made your profits. Why did you make your profits? How did you make that profits? You made it because there was volatility. If there was no volatility, you wouldn't have made profit in that short period. And most times, this lasts only about maybe 30 minutes, maybe 1 day, maybe 2 days. So that is why we use that word position. You position for it. So whenever news is coming out from the US, from the Federal Reserve Bank, or whenever news is coming out from the EU zone, from the European Central Bank, or for us in Nigeria, when news is coming out from the Central Bank of Nigeria, it affects the currency pairs, Naira dollar, USD euro, UPB USD, or GBP euro. Those are the periods. Those are the opportunities you see when it's time to trade volatility trading and make your profits. So why is volatility important? I just mentioned that people don't make so much money in the normal volatility. They make profits during implied volatility. So they position for it. So volatility is important because there are swings within that period of volatility. There are price swings. So without volatility, there will be no profit potential in the market at all. You will just be trading over like 2-3 months and you've been getting 1 or 2 pips, profits, very small profits. But once there's volatility, it increases your profitability. But do not forget, volatility also increases your risk associated with these trades. So while I'm looking at it, remember that's what they call the risk and the return. Like I always remind people, in a company, when you have a profit and loss account, it is not a profit account. It is a profit and loss account, which we also call our income statement. So sometimes we make a bit of a loss, a bit of a profit. But for traders, they have what we call a stop loss limit. So you can make a loss to a particular limit and stop. So if you make a loss, $100, $1,000, $10,000, you may have put a stop limit at $15,000 because you know that you can easily trade and make $25,000, and that will give you a net of $10,000 positive. So remember that there is risk and return in the FX, in the Forex trading. Now, how do you measure volatility? Traditionally, it's measured using standard deviation. This is a bit technical, but for those who have logged into FXCM or Oanda and have traded, you will learn all this when you're learning your candlesticks. Now, the standard deviation measures how far away your current price trades relative to the mean or the moving average. So if the average price is, let's say dollar to pound, is 1.5. If you bought at 1.2, at 1.5, you're already making profit of 0.3. So you measure that volatility based on that. Then other factors can affect it, like news reports. We just mentioned that news reports affect volatility. Macroeconomic data that come out from the central banks affect volatility. The earnings report from companies and political and national issues also affect volatility, which is why we say once there is going to be news that will impact your trading, you position for that news and you ask your analysts, you check your economists, they will interpret to you, what will the news do? Will the news bring about an upward movement, or will the news bring about a downward movement? If you have a certain position, you have to position to ensure that your trades will make you profits. Now, the next slide says that monetary policy meetings of a central bank can have large impact on volatility, which I just mentioned some time back. So if the central bank lowers your rates, it has an impact on the market. The market will react. If it increases rates, the market will react, and it will affect the domestic currency. So in Nigeria, the news on BDCs affected our domestic currency. It devalued it. So our currency moved from the 400 levels to the 500 levels, from the 501 levels to the 510 levels, from the 505 levels to the 512, 515 levels. This was negative for the Naira due to that announcement from the Monetary Policy Committee of the Central Bank. Now, traders who are volatile traders are not interested in direction, like I earlier said, of the movement. They make profit purely on that volatility. So they wait for it, they enter into it, and they come out when volatility is a bit low. Now, the straddle strategy is what most of them use. It's very popular. So you straddle, you aim to take advantage at a particular price to return your profits. Now, this is how straddle works. It returns a profit when the price goes strongly in one direction, whether it is up or it is down. So imagine, let's use a Naira dollar to make it easier for understanding. You buy, you know that news is coming out from the central bank today. You have traded Naira at 405. You bought it at 405. And you know that the news is going to be negative for the Naira. The minute the news comes out, there's going to be a spike from 405, it may hit 410. If you buy 1 million and it moves by 5 Naira and you sell, you've made 5 Naira on that currency. And that spike may last only 10 minutes initially, and then it starts normalizing after a while. But what have you done? You have used the strategy of straddling to put a limit on that, your trade. When it gets to that limit, it cuts that trade, and then you make your profits. Now, let us go to the real trading, because most people don't trade USD Naira. They trade Euro USD, they trade Euro GBP or GBP Euro, they trade Euro USD, they trade USD GBP or GBP USD. A typical example is shown on the slide, this slide. Now, this is part of straddle, where you have a stop loss limit and a buy limit. So if you go back to this slide, let me take you through what pending orders are. Pending orders are orders that become market orders once they hit the pre-specified condition. So the condition is that I have set my currency. I'm going to buy at 1 point. I'm buying euros with my USD. I'm buying at 1.2. I'm going to buy 1 million euros. I'm going to set my pending order because the news that is coming out, we are sure is going to make the euro hit 1.8, 2.0, 2.2, 2.3. I will put my order while having bought at 1.2 at 1.8, knowing that it's going to hit the 2.0 mark. Now, don't be too ambitious. Do not put it at 2.3. You have bought at 1.2, put it at about 1.8. Put your order there. When you put your order there and there's a spike, it will hit 1.8. You take your profit from 1.2 to 1.8, you make 0.6. And then it moves higher. Once it has taken that, you can now go into the market again and buy. But do not put a pending order at 2.3 because it may get to 1.9, 2.0, and have what they call a resistance. A resistance is when something is trying, a currency pair is trying to break a barrier from 1.7 to 1.8 to 1.9 to 2.0. It starts fluctuating between 2.0 and 1.95, 2.1, 2.01 and 1.97, 2.02 and 1.92. It's trying to break that resistance. Sometimes it doesn't break that resistance. And what happens? It goes all the way down. So if you got at 1.2, put a pending order at 1.8. When it hits 1.8, going to 2.0, you've made your profit. So you do your take profits. But those who are trying to be ambitious, believing that the news will make the currency move from 1.2 to 2.2 to make a whole 1 unit. You find that we get to 2.0, 2.01, 2.02, and then it comes down. At that point, your pending order did not take your profits. Why? Because you are being overambitious with it. So traders have to be very cautious when they are doing this straddle strategy. Ensure with the news that you do not go overboard. If you expect the currency to move by 10 or 20 pips, put your pending order at 7 pips, not 10 pips. So that once there's that spike in volatility, it catches that order and you made that profit. Then you know the direction of the market after a few minutes or a few 30 minutes, 1 hour or so, and then you can enter the market again. When you enter the market again, remember, you've already taken your profit, so you're satisfied with that. Anything else you're doing is a bit of extra on your part. The same thing as the buy stop order. This is what I just explained. So you will put a stop at your buy order. When it gets to that mark, if you take that order and then your trade is over with your profit. It's the same thing as the sell. Now, if you sold at 1.5 euro to USD, and you know that news is going to come out, that will make it go all the way down. What you do is you position it to buy at 1.1, knowing that it's going to go from 1.5 to 1.4 to 1.3 to 1.2 to 1.1, and may even go down to 1.0. But remember, do not be overambitious. If you sold at 1.5, put your buy order at 1.1 or 1.2. So when it goes from 1.5 down to 1.2 or 1.1, you take your profits and then you move on. So it happens for both buy and sell in the straddle strategy. This is an example where you can say that the price broke. The buy limit shows you there. It goes down and then it can come up again. The diagram shows that the one on the left, there is a buy limit. The arrow is going all the way up. If you look at the one on your right, it gets to that certain limit and it cuts it, and you're taking your profit. So the advice here is, as a trader, study your economics, study the news that is coming out, know what the volatility will hold. Will it go north or will it go south? Use the straddle strategy, enter the market, and place an order where you feel volatility will catch it. It is difficult to trade clicking and clicking during volatility periods. So the best thing to do is use a straddle strategy. Just check where it's going to be, program it at that point. When it starts going up and down and up and down, it will just catch your order and you make your profits. In reality, when you try to trade during volatility, you find out that sometimes the system will even hang because of the volatility of the market. So when you want to click on something, before the click catches it, it goes down and you may not be able to catch that exact point you want to catch. So this is the same thing we're talking about, taking profit on the sell side. You sell at a certain amount, as it goes down, you buy, okay, from at a lower limit, which means you sold at point A, you bought at point B. You sold high, you bought low. Conversely, it means you bought low and you sold high. Remember, all currency pairs are not the same. When you want to buy and sell in Japanese yen, if you're doing yen dollar, in Japanese yen, you actually buy high and sell low. You don't buy low and sell high. So be warned. It's very technical and you have to study it before you enter into the trades. Now, since volatility is what triggers a pending order in your strategy, traders often use this strategy just before important market reports, as I mentioned earlier. The reports create that enormous volatility. And because it is difficult to catch it one at a time, straddle, program, and let it catch your intended trade. Try your best possible to use your judgment. Do not be greedy. If you make profits once, make profit the second time, make profit a third time, you may be greedy to go into the market to straddle again, and you may just make a loss. So you find out that the principle is during fluctuations, during volatility, it is important to straddle. Don't trade. Place your orders at the point that you believe that the volatility is going to catch your order, be it on the buying side or on the selling side. So I believe that I have covered most of my slides. And at this point, I would say thank you. We know that Forex trading is extremely, extremely technical. If you have not studied it and you are going to use one of the platforms, you will find out that each platform has an update, which gives you the expected news to enable you trade. Without economic news, without fundamental analysis, without technical analysis of your candlesticks for those who trade, you will find out that you will not be able to get or optimize your trades. So thank you very much for listening. As we await any questions from you, I'm sure there are a lot of questions. Some may want to video this, record it, and then check out everything I said again. Yes, it is expected because this is a very technical topic. Thank you.
Thank you very much, Mr. Anthony, for this presentation. I don't know if Babajide is still there. Are you there, Babatunde? So please, everyone, feel free to ask questions, questions from this webinar section that
Hello?
we're just having. Please drop your questions on the comment sections. Please kindly drop your comment. Hello, can you hear me?
Yeah, but Babatunde is here. Yeah, Babatunde is here.
Okay. Babatunde,
Yeah.
we have just concluded the webinar.
Yes, I've been.
Hello?
Hello, yes, I'm with you.
Okay, over to you, please.
All right, thank you very much. My mic was restrained the other time, so I couldn't come in to talk. Thank you very much, Mr. Anthony. That was quite an insightful piece from you. And honestly, it's been quite revealing. Many of us that were at some point in time in banking, we knew that, especially for guys like me that were in control, FX and FX trading are areas that were considered a no-go area. So learning from you right now is an opportunity that we never had those days. We just left all those guys that were in FX and trade services to handle such. So executive students, if you have questions, for me, I would have just loved to ask you, based on what you just shared with us right now, do you have some news sites that you can share with us where we can go for news to get abreast of information about FX trading?
Okay, if you look at the slides, there's a slide that showed the top trading platforms. I think that would be slide 20. It showed Pepperstone, Oanda, FXCM, Plus 500, FX Pro, eToro. You will see that when you log into any of those sites, they have a portion that guides you in trading, almost on a daily basis.
Okay, thank you very much, sir. There's a question here, or would that be taken by the didactic team? There's a question by Shino Alabode. He said that the dynamics of the Nigerian foreign exchange market shows possible devaluation of Naira by year end. So can you maybe speak to this, maybe giving us an heads up in terms of, or you predict the devaluation, where to go? Probably if there are some people that are interested in taking positions with Naira, what they can do.
Okay, thank you. Your question is one of the most valid questions today in the economy. Your question is a question that international economists are asking also. Now, people like Standard & Poor's, S&P, Fitch, and such rating companies have looked at the Nigerian economy, and usually they do a 5 to 10 year outlook. In March 2020, I recall doing a transaction with somebody, and the person was talking about buying that dollar at 380. And this is what I said to him. If you do not buy it now, this time next year, you buy it at 480. And why do I say that? The demand far outweighs the supply for dollars in Nigeria. We are a country with very vast, large population. If I had to give you advice on this, I would explain and then I will answer the question. So if you have a population of between 150 million to 180 million Nigerians, and you are a typical manufacturing company, and you provide biscuits or FMCG, the fast-moving consumer goods, every day the population is growing. Every day babies are being born. When you provide those products, they're going to pay you in Naira. But remember, you imported raw materials using your dollars at a certain price. When you sold, you get Naira with your profit, both your profits and revenue and all. What do you do with the Naira? You want to pay back. If I assuming you opened an LC, your LC was for importing chemicals to produce. You have finished your production. They have paid you Naira. Your account is swimming in millions of Naira, 100 million, 200 million. And you want to pay back. The demand is there. So you have 11, 12, 30, 40 FMCGs requesting for this. So the demand is high. So if Shino says, I have $1 million to sell at 450. Company A says, I won't buy it because I want to buy at 445. Company B says, look, I need the dollar more than company A. So I'll even buy it at 455. Another company comes and says, look, let me buy it at 458. Another company comes and says, look, I will buy it at 460. Just give it to me because it's important to me. Now, what is happening? The demand is growing. The price is rising. So you can see the dynamics already. Because of that high demand, it's going to keep rising. So the answer to your question is, there's a possibility that we could hit 600 by the end.
Wow.
Because how many years after December this year, if I have to go back to my slides, at December this year, the Naira to dollar, even in the black market, December 2020, in the black market, it was less than 480. Today, we are seeing 410, 510, 515. So we have moved to 490, to 500, to 510, and we're even increasing, which was in 6 months between December and now. So if you extrapolate between now and December, you can imagine what we should have. That's the answer to your question.
That's great. Thank you very much, sir. Thank you. Yes, that's quite instructive. And for some of us that have been saving up, what some of us have been doing is to convert our savings to USD. Is that because I have friends that are doing that too? Is that a safe way of doing that, of taking position or being careful to mitigate the risk of volatility in a Naira?
You just brought out the answer. You said position. So when you position, what are you doing? There's an intent. Yeah. There's a reason why you're positioning. For instance, if I had business in Switzerland, and I know that every 6 months, I must buy a certain component of that business. So I'm a Nigerian firm with presence in Switzerland, and my balance sheet is in Naira, not in Euro. I'm going to be buying that money, position for Q1, Q2, Q3, when I need to buy that raw material for my production. So I have to buy it now. Okay, Anthony Wonsu has just spoken to you. Oh, Tony says that it's going to be 600. So now he's doing 505, 502, 508. Let me buy it now because by Q4, we are already in Q3, right? So by Q4, we'll be talking about 550. So let me buy it now and save 20 or 30 Naira because of what the advice I gave. So what you're doing, you're positioning yourself by buying it and keeping, because there's an intention to use it for something. So if you're looking at yourself as an individual, what are you positioning? Are you positioning that later you're going to sell it and make a spread, buying it at 480 and selling it at 520? If not, are you positioning because you're going to travel abroad to use the money to do other things and you want to buy it cheaper now? Because by then, when you want to travel, it may be more expensive. Do you have a mortgage? In that case, you go to your bank because central bank is going to sell to you under invisibles and you can buy it at central bank rates. So those are the reasons why people buy, because there is an intent. So if you have an intention, then you position yourself and buy now. If you do not have a position, then you just have to go with the flow as it is.
Thank you very much, sir. There's a question here. Someone is asking, and I think it's one of the questions I noted down. Is it possible to believe that this training, that there should be a follow-up to the training? Do you train people, or where can you recommend that people can go to train FX trading? Because it's not something you just get with just this one encounter, you know.
True. FX trading is like studying. A medical student who knew about cancer 10 years ago has to study to know about the latest symptoms of cancer. For those who have had malaria many times, there was a time we used to take chloroquine. Now we're taking Lonart and we're taking Amatem. It's the same way as the FX trading thing. News comes out every day. 5 years back, there was no Brexit. Now there is Brexit. So there is differences in the zones and in the currency strengths. So yes, you will have to consistently train. Now, when you enter those sites I told you, you will see a portion, usually at the upper part, that says, how can I help you? When you click on that, you will see a chat assistant. Ask that assistant any question. They will bring up sites, they will answer your questions or give you sites you can go to and learn those things. FXCM is very strong on training. If you log into www.fxcm.com, you will see all those things. You will see the site there. Or Oanda.
Okay.
Oanda, FXCM are quite strong on. And also MetaTrader. So Oanda, MetaTrader, FXCM. If you check those 3 sites, you will see daily reports, daily trainings, and information you can use to trade. Remember, FX trading is purely based on information.
Good.
If you log into any site, it is based on information. They'll tell you there is news coming out from Europe today for this. You are trading based on that news. Traders are trading based on something. I have traded before, sometime in 2008. A Russian bank had money and wanted to sell off dollars. I think what happened was that they had invested in the stock market in the US. And when the stock went high, they sold and they got dollars. So they were selling the dollars to get back their own currency. That day was a day where myself and my colleagues made a loss of $2 million. So the thing just kept going down, going down, going down, going down. We got the market information, but we didn't act on it. So that information made us make a loss. But what did we do? We had our stop loss limits. So it cut our losses where we knew we could manage it. And then the next day, we listened for news and started trading again. In about 4 working days, we got back over 2 million plus. So net for that 1.5 weeks.
Great. Thank you. Someone is asking, like, what's the lowest amount one can start trading with?
The lowest amount is dependent on the platform you use. Some platforms will tell you $200, some will tell you $100, but it's not a large amount. Between $100 and $200, you can start trading your FX.
Oh, great. All right. There's also an executive student here that had traded before and lost the investment.
Wow.
Everything. And is now asking, or she's now asking to know, how could you encourage someone like her to go back into trading?
And whoever you are, I'm sorry about your loss. But like I've always said, that's what they call risk and return, profit and loss. The FX market is very volatile. I will encourage you to go back. Get your $200, $300, $500. Today, $1,000 in the black market is over 500,000 naira. So $500 is about 250,000 naira, and $250 is over 125,000 naira. If you invest that and enter the market, do not trade until you get news of when the ECB or the Federal Reserve Bank is about to bring out news. They bring out different types of news: consumer price index news, FOMC news and stuff like that. The day before they bring out that news, go and study your economic analysis, your market analysis, your technical analysis. Know where the direction is going to go. Enter FXCM, enter Oanda. On the question side, click. I want to do this. What do I do? They will respond to you. It will tell you if it's going to go high or if it's going to go low. Based on that, you know whether you're going to sell and buy back, or you're going to buy and sell later. Do not trade until there is news that's supposed to come out, because it is that volatility that will make you make profits. Then do not ask that you want to make 100 pips. Pips means percentage in points. So if a currency is doing 1.2, go and put a pending order at 1.3 or 1.4. Don't go for 1.6 or 1.7. Just take the minimum. The minute you do that, you find out that you make profit, and it gives you that confidence to start again. And trading is very psychological. If you make a loss first time, second time, you won't want to go back again. But I encourage you to start a small amount and watch out for news. The news is very important. That volatility will make you get your profits. And don't be greedy about it, little by little. If you had money to trade, imagine you made just $100 every day, not more than 100, 50 to 100. People make up to $1,000, $2,000, $3,000 a day. But imagine you make 100 a day from Monday to Thursday, leave Fridays. You've made $400. Convert $400. It's over 200, it's over 150,000 naira in just 4 days. We always look at it from that point of view. Thank you.
Thank you very much, sir. What is key and critical here is knowledge. So we have to, and that's the opportunity Room Business School is giving us. We have Akachukwuche raising his hand. He wants to ask the question. So please, you have the floor.
All right, thank you very much, sir. I have had the opportunity of trading for a while, but there is a gray area I do not understand totally.
Okay.
Now, when you set up your trading accounts, I use FXT. I don't fully get the concept of leverage. So you set up an account, they'll tell you that, do you want to leverage at 1:100, 1:500, 1:200? I don't understand what it means. And since we're opportune to have someone that is experienced in the system, I want to gain clarity on that.
Okay, I will not want to confuse you.
Okay.
Leverage, hedging. Sometimes I use interchangeably. So let me use the word hedging to make you understand easier. So assuming I bought, now I'm talking on the corporate side. So let's assume I'm trading for a bank, not for myself. Let's assume I bought $100,000 at, I'm doing dollar to pound, pound to dollar. So I've bought pounds, 100,000 pounds at 1.3. Usually it's 4 decimal points. So you have something like 1.3152, 1.3153, 1.3154. So if I bought at 1.3 or 1.31, and I found out that I made a wrong decision by buying at that rate, instead of waiting for it to go down to 1.1 before buying. Now, what is happening is that the market is going down from 1.3 to 1.1 to 1.2. I've already bought at 1.3. Two things can happen. I can cut my loss at 1.2 and enter the market again. On the other hand, you can hedge it or leverage by doing a fresh trade. What you do is you have bought at 1.3, remember, hoping that it goes to 1.5 and you make a profit of 0.2. Now, having bought at 1.3, go on another side and sell at 1.3 or 1.4. Now, look into the news and see if your 1.3 is going to go up. If it is going to go up, usually the movement is downward first, then it now goes up. You have sold at 1.4 and you have bought at 1.3, same 100,000. So one of you want to hedge the other. So the one you bought is sold at 1.4 is going down from 1.4 to 1.3, 1.3 to 1.2, 1.2 to 1.1. At 1.0 something, that thing you sold at 1.4, buy it back at 1.0 something. You've made a profit. What that profit has done, it has hedged against the loss you're going to make on the other 1.3 you bought, because you sold high and you bought low. Then you now, based on that news, wait for the news to go up. Now, if the news goes up from that 1.1 to 1.2, before it touches 1.3, just sell off that one. You've made a loss of 0.1, but you've made a gain of 0.3 on the other side. What you have done is you have hedged your trades. You have hedged your trades. Some people use that word hedging, some people use the word leveraging. You're leveraging on one thing to do the other. So I know that sometimes it gets confusing. So I use that word hedging to make you understand it better. So whenever you do a buy and you find out that it's going down, either you cut your losses totally from 1.5, it's going down to 1.3, 1.2, 1.1, cut your loss, you've lost 0.4, start all over again. Or if you want to keep your 1.5, sell at that 1.5. If it drops down to 1.2, you buy back. When you buy back, you've made a gain because you've sold high and you've bought low. You have sold high and you have bought low, which is opposite of you have bought low and you have sold high. So you made a profit. within that movement, when you see any other movement that works for you on the other side where you bought, you can now catch it. So two things will happen. You have either made a clear profit or you have reduced the loss you are going to make. I hope you understand that.
Thank you very much, sir.
Yeah, thank you very much, sir. We have Vivian. She's raising her hands for questions. So Vivian, the floor is yours.
Okay.
Okay, good afternoon again.
Good afternoon.
Yeah, thank you so much for this very technical presentation. Forex trading is an area that I wouldn't want to go into because of the volatility, as you just explained. And I left a message in the chat box, but it was not read out. I don't know whether it's not seen. I want to know if we are going to get this presentation sent to us in our emails. And then I also want to get an advice for you for somebody who is not trained on this Forex trading techniques. Can you just go to the site that you recommended now and just start trading? The person is likely going to get the fingers burnt. So two answers, please. Are we going to get the presentations and then the advice on whether to just go to the site and start trying your hand on how to trade? Thank you.
Okay, thank you. The presentation, Rome Business School is definitely going to get back to the students on getting the presentation. I'm sure that can be done. Philip, Funke, I believe you are hearing the question, so you will attend to that. The second question was on going in by yourself to just start trading. I did it. I went into a site, asked all the questions, and I did what they call dummy trades. You do your dummy trades to test it. So you're actually trading, but it's not being recognized anywhere. Under normal circumstances, when you do your trades, you open an account. I would say Standard Chartered Bank is an international bank. Stanbic is an international bank. You can open domiciliary accounts there. So that when you make your trades, they will come in dollars or they can come in naira if you want to. That's in the real sense. You actually open an account so that when you are doing your trading, it's going to be hitting somewhere and they can move it to your account when you made your profits. But when you're about to start, let's say you enter Oanda or MetaTrader today, you go through the help desk. They will tell you what to do. They will even give you phone numbers. Pick up the phone, call them on phone. They're going to talk to you. On the phone, they will direct you on what to do. You now start your dummy trading. So you are trading like every other person, but there is no profit or loss happening. Just dummy trades. After 1 week, 2 weeks, 1 month, you can do dummy trades for 3 months if you want to. When you get comfortable with it, buy your $100 or $200 or $300. Now try it. But please try with a very small amount as a fresher, because I can bet you that day your heart is going to be pounded. In fact, to even click, you may double click. You may, instead of buying 100, you may double click and buy 100. So you have to do the dummy trade over a period of time. And when you're comfortable with your dummy trading, you cannot enter the real trading. But go to the sites when you want to do the real trading. Ask them how they're going to do the accounts and the profit taking. And talk to them on phone, not just chatting. They will speak with you because they're always willing to, because the trades they are doing, remember, they're making profit from it, not just you. That is why they always invite everybody to come. Imagine making 10 kobo from 100 million Nigerians in 1 day. So calculate 100 million times 10 kobo, what you make. And you make that every day. So imagine that this is how the trading platforms are. For every trade you do, they're taking their own profit also from it. So that's my advice.
Thank you very much. You're
welcome.
Thank you so much. The explanation is taken. Thank you.
You're welcome.
Thank you very much, Mr. Tony.
Thank you, brother.
Yes, I don't know if there's any other question. Yes, looking on the platform now, someone was asking a question about inflation.
Okay,
How do you track inflation?
Increase in the country. When you use the word track, I need to know exactly what you mean. Do you mean how do you get the news on inflation? If that is the question, the official window, if you go to the central bank, centbank.org or .gov, I think centbank.gov. If you go into central bank websites, there are different aspects. You will see monetary policies, see currencies, you will see reports. Go into the reports, you see inflation reports. It will show you from the Office of Bureau of Statistics, the inflation reports over the years. Now, what I do what people call trending. If I want to look at inflation and say, okay, what will inflation be in the next 5 years? I would go and do a 10-year trending and check the graph of inflation from 2010 to 2020 and watch it. If it's always upwards, I know that the trend will continue. But if it goes down in maybe Q2 or goes up in Q3, I know there's a trend that in Q2, Q3 it may go up or go down. This is just trending to, give me an idea. It's not the real thing. But that way I monitor inflation based on trends. But when you say you want to track, how do you track inflation increase? It is by going to central bank site, Bureau of Statistics, and you will check and see the inflations that were preceding the current inflation. A few quarters back, I think inflation was in between 12, 13, and 15. Today, it has hit about 18. So that is showing an upward trajectory. So inflation is getting worse based on that trending. This is just a brief trending I did a few weeks ago. So that is how you can get any information on inflation. Go to central bank website, go to the Office of Bureau for Statistics, and you see the statistics there. They give you that kind of information. Thank you.
Thank you very much, sir.
Oh, one more thing.
Yeah.
You can go to FMDQ, www.fmdqgroup.com, www.fmdq, Financial Market Dealers Quotations, FMDQ Group. You will see daily rate inflation reports every day. That will definitely guide you.
Thank you very much, sir. And thank you for being very practical and at the same time being very technical with your deliveries and the teachings. And we can say that today, at least for the first time in a long while, for someone like me that is a little bit averse to FX trading because of its volatility and the risk, I can say yes, with information right now, I can venture, and I can assure that very soon I'll start trading I'll start my own trading.
Imagine when you start, please use the straddle strategy so that you do not click the wrong thing. The straddle will position you, so when you have to buy, it just clicks on the buy for you and it's done automatically.
That is it. If the straddle strategy actually made it, less stressful and less risky for me. Thank you very much, sir. And thank you, executive students. I want to give the floor back to Funke.
Okay, thank you very much, Babatunde. Thank you very much for that. Mr. Nwosu, thank you for joining us on this section. We really appreciate this insightful information that you have given us today on the success of a trader. So one thing that we have gained today is the success of a trader. It depends on his judgment and how it applies it in his trades. This is very insightful. We really appreciate this section, and we hope that everyone that is listening to us will be able to implement this and take it up from here. They'll be able to start their own tradings, and they will be to come up successful in their trading. In their tradings. Thank you very much for everyone that participated in this webinar section today. On behalf of Dr. Humphrey, I want to say a big thank you to Mr. Anthony Nwosu, our faculty members. I can see Mr. Shino, who is here. We want to say big thank you to you. And for everyone on behalf of the Rome Business School and the staff of Rome Business School, we want to say big thank you. Thank you very much for participating in this program. We really appreciate, and we hope to see you in our next webinar section. Thank you.
Thank you, everybody, and have a nice day. Bye-bye.
Thank you, everyone. Bye.
Bye. Thanks.